she had a fairly complex situation. It would be about 20 grand. And she's like, I don't want to spend the money. I don't think I'm at risk. Well, in the end, she ended up losing millions.
This show is brought to you today by Lightbulb Podcasting. Are you a busy professional that needs to get more time back in their schedule? If you are a podcaster like me, you have enough on your plate. Why not outsource your podcast production? From editing, show notes, keywords, scheduling, volume balancing, and editing, and creating audiograms, podcast production is another job in and of itself. That's why I use Lightbulb Podcasting. Get phenomenal support at an affordable price while you concentrate on growing your brand. Go to www.lightbulbpodcasting.com today to schedule an introductory call. Put your content in the spotlight.
Are you tired of the 9-to-5 lifestyle? Do you want more freedom to do what you want, when you want it, without sacrificing your current income? Then this is the show for you. Every week, we dive into John's journey towards financial freedom and everything he has learned since 2014. Real estate investing, cryptocurrency, stocks, private lending, foreign residency, tax saving strategies, infinite banking, assets protection, and much more. Now, here is your host, the founder of the Wealth and Freedom Nexus, John Rickgarn.
Good morning, afternoon, or evening, depending on when you're listening to this. This is John Rickgarn, your host, as always, of the Wealth and Freedom Nexus podcast. Now, if you've been joining us since the beginning, we've touched base on numerous ways to build wealth and build up passive income streams. The downside, if you want to look at that, after a while when you're successful, unfortunately, you have to be on the lookout for two destroyers of your wealth. And what are those destroyers? Well, one could be excessive taxation. If you live in the Communist Republic of California, for instance, you might be hit up from everything from higher property taxes to sales taxes. But then also, unfortunately, if you're in the United States like I am, we lead per capita for lawyers and frivolous lawsuits, and always have creditors and predators out there to do drive-by lawsuits and try to take a chunk of your earnings, your wealth, your assets, if you will. With that, today's guest, I brought on Bobby Casey of Global Wealth Protection. As you can probably tell from the name, he specializes in helping especially digital nomads, entrepreneurs, and expats help properly structure and shield their assets from creditors, and also maybe set up new jurisdictions so that they're not impacted as much from taxation. With that, Bobby, welcome to the show.
Hi, John. Thanks for having me. Yep, actually, I like your intro there, and you're right. The thing is, with a lot of entrepreneurs and business owners, investors too, we're constantly focused on growth. We always want to grow our wealth. We're focused on the next deal, the next new product launch, the next new hire. Growth. We're growth minded. We're focused on growth constantly. The thing oftentimes as entrepreneurs we tend to forget about is the risks and the things that actually can rob us of our wealth. So we spend all this time and energy on growth and we forget about that other stuff. And I'm just as guilty of it as any other entrepreneur. I'm always out there focused on a new product launch, a new business, a new deal, a new hire, that sort of thing. And so a lot of times these things we tend to forget about. I did a article. It's actually been several years ago, but it's pretty relevant still. You can actually just go to our website, globalwealthprotection.com, and you can do a search for this blog post. It's called "A Penny a Day Doubled." Yeah, and I'm sure you're probably familiar with that penny a day doubled analogy. You think, oh, one day you have a penny, 2 days you have 2 pennies, 4, but after a month, you've got several $1 million. But I did a little bit different spin on that penny a day doubled analogy, where we did the penny a day doubled spreadsheet in an article, and then we factored in taxation on the difference between doubling your money every day for 30 days and then factoring in a tax that as being a capital gain event on every time you doubled it. And the difference between doubling it without tax and doubling it with tax was it was several $1 million difference over a 30-day period. Now, obviously, the example is just kind of for fun, just kind of a thought exercise, but it is kind of relevant, especially when you think about your life over a 10 or a 20-year period of time. Because if I make $100,000 a year and I pay $40,000 in tax every year, you know, I've only got net in my pocket 60 grand to pay for everything. Whereas if I could save $40,000 a year or $30,000 a year, and I don't change my lifestyle, what do I do? Or what can I do, really? Let's say I save $20,000 a year in tax, but I don't alter my lifestyle in any way. I can roll that $20,000 straight into an investment account of some sort, whether it's crypto or real estate or stocks or bonds or whatever you want to invest in. And so it has a massive, massive impact on your wealth, especially when you factor in the compounding effect. So taxation is a major thing. And then, like you mentioned too, litigation is a tremendous event, especially if you are an American. And I did an article on this years ago too, and I don't remember the details, but it was something like there's a new lawsuit filed in the U.S. something like every 13 seconds.
Yeah, it's I think, pretty high.
I may be off on those numbers. I literally did an article on this and did a full research on it, and now I don't remember off the top of my head, but it was like every several seconds there was a new lawsuit filed in the U.S. And so that's another thing. Like if you don't have the proper structures in place to protect your wealth, you're fully exposed. And like most people don't think about it. And most people don't think it's even something to consider. Like, you know, I have tons, like I had a real estate client years ago, huge real estate investor. I mean, I say huge. I mean, he had, I don't know, a few hundred doors. I say doors, meaning some of them were fourplexes, some of them were single family homes, some of them were duplexes. So, but he had several hundred doors, and every single property he owned in his own name. Personally.
Oh boy.
Every single property, because he didn't know any better, and he just thought, we'll just, you know, we'll keep buying these things in my name. And he made a lot of money. And he had millions and millions in assets. But just like you have one slip and fall incident or one person, you know, you have one tenant who decides to build a meth lab in the kitchen of your duplex and blows the house up and kills their neighbor. I mean, you can be completely wiped out. And I actually had that happen with a client. Like this is actually kind of my kind of joking example that I give to real estate investors. You know, what happens if you have, you know, multiple properties and one of your tenants decides to build a meth lab in one of your houses and blows it up and somebody gets killed? You potentially expose yourself to everything. And I use that example with one of my clients in Dallas, Texas. And he goes, that's not really a funny example for me. And I said, okay.
What's up? Please.
Tell me more. You know, I have questions. And he goes, that's actually why I'm calling you, because this actually happened to me. He said I had 10 rental houses, and one of them, my tenant had a meth lab and literally blew the house up, and nobody died, but a bunch of people got hurt. They got burned. And he had some pretty significant lawsuits associated with that because he was the tenant on the property. And I said, well, tell me about the structure of your ownership of your business. And he goes, yeah, I owned all my houses in my own name. And I'm like, oh my God. Like, you know, but people think I don't need to worry about it. Nothing will ever happen to me. Well, that's the thing with unforeseen circumstances. They're not foreseen, right? Right. So like, you know, I consider it a little bit like, a proper asset protection plan is a little bit like some cheap insurance that you put in place to protect yourself. Like the analogy on insurance is, you buy health insurance to protect yourself from a major catastrophic event, like, brain cancer, for example.
Right.
And protect you and your family from a major catastrophic financial loss from, a major event like brain surgery, right? But kind of like with asset protection, you put an asset protection plan in place to protect you from a major catastrophic loss, just like you do with health insurance to protect yourself against, this brain surgery event. But nobody buys health insurance hoping, man, I really hope I get brain
Right.
cancer so that I can take advantage of all these premiums I've been paying for all these years.
Exactly.
Same thing with an asset protection plan. It might be one of those things that you put a structure in place and you maintain it for years and years and years and nothing ever happens. Well, that's kind of a good thing.
Right.
It's kind of a good thing that you don't have to go to court and defend a multi-million-dollar lawsuit. Yeah. You would have the structure in place to protect you, but you still don't want to do it, right?
Yeah. Well, I kind of even look at just as simple as, putting on a seatbelt when getting in the car. I mean, knock on wood, I have never gotten in a, serious car accident, but not to say that, okay, I've put on my seatbelt, nothing happened. That's great. But if I get in a serious accident, I can't, well, gee, I better put on the seatbelt now. And that's going to reverse all the injuries that I just sustained on this, huge car pileup or whatever happened. Well, maybe taking
well, I have that happen to me all the time.
Oh, geez.
I have that happen all the time. Like in kind of that example, people come to me and say, hey, I had this major, I just got sued. Like I had somebody not recent, but a few years ago, who had went in with 3 partners to buy this massive apartment building in Ohio. And I mean, like a 2,000 door apartment complex. And they went in with a couple of partners and they, took out several $1 million in loans, actually with Wells Fargo, to buy this complex. And everything was going fine until they found out the building was infested with black mold. And so it ended up getting condemned, and everyone, basically they condemned the whole building. But you know what? Wells Fargo doesn't care too much about whether you have income or not, right? Because you have a personal guarantee on it, and and you've got a lien on your property and stuff. And so Wells Fargo didn't care a whole lot about this black mold issue. Yeah, I mean, they didn't do a great job on the inspection in the beginning. They probably should have dug in a bit deeper on an inspection.
Yeah.
But and I ended up, 3 of the owners of that building came to me as clients and did an initial consultation. I actually wrote about them also. I called them the 3 little bears of asset protection because one of them kind of built his brick house, so to speak, right? So one of them, he did everything I recommended. We put everything in place, and he was mostly protected. One of them built his stick house, and he was kind of half and half protected. He didn't want to spend all the money to put everything in place. And he ended up losing a bunch of assets in the lawsuit with Wells Fargo, but he did end up protecting the stuff that we set aside for protection. And then I had what I call the straw bear. She came to me and just decided she didn't want to spend the money on putting anything in place. Yeah. And this woman was about 67 years old. And to this day, she had to go back working part-time. And she was prior to this, she was worth millions. Okay. Because she had a bunch of real estate. Outside of this lawsuit with Wells Fargo, this apartment building, she had tons of rental properties. She got wiped out, everything. She lost everything, including her own home. And so now she's living on Social Security and works part-time at a florist to this day. So I call her my straw pig example, because she chose to not put in place what I recommended to protect her. And she ended up losing everything. Literally, it could have, the entire plan she could have put in place would have been about $20,000 for everything, because she had a fairly complex situation. It would be about 20 grand. And she's like, I don't want to spend the money. I don't think I'm at risk. Well, in the end, she ended up losing millions
Wow.
because Wells Fargo basically just wiped her out. Wells Fargo took her to court and they seized all of her other assets,
Jeez.
forced everything into foreclosure, and she lost everything.
Yeah.
It was crazy.
Yeah, it's funny you mentioned that, and I don't know whether it's an accident, a lawsuit, whatever the case may be. As strange it is, I always refer back or think back to an old Calvin and Hobbes comic years and years ago. I remember that the mom and the dad, they came back, their house was broken into, and the dad says, "Oh, this is something you always assume is going to happen to someone else." And the mom said, "Yeah, but we're all someone else to someone else." And for some strange reason, that's always stuck with me. It's like, we're all on the same planet. We can always say, "Oh, this will never happen." Well, someone else is probably saying that same thing, and you might be the person
Right.
you think, "Oh, you're the someone else this is going to happen to." So
Yep. You are someone else's someone else. That's I
Exactly.
like that analogy. Yeah.
So, now, I'll include a note or a link to that in the show notes for the penny doubled you mentioned there, Bobby, with the impacts of taxation and, tax-free growth versus taxed growth. Maybe just, taxes, we could go down the rabbit hole, I'm sure, for hours on end, but I'm sure a lot of my listeners are, familiar with, tax deferred strategies like in an IRA or tax-free. If that compounding you mentioned, if that wasn't, say, a Roth IRA, well, that would be truly compounded up to the millions of dollars versus a traditional brokerage account getting hit with capital gains after every transaction. Maybe high level, could you maybe share some examples or maybe even an example of a client that came to you that, whatever the case may be, I'm in California, I'm self-employed, whatever, and I'm just getting hammered by 40-50% taxes, and maybe you were able to structure their activities to cut that tax bill in half?
Right. So I told you this earlier, John. A lot of my clients are location independent entrepreneurs. And this is a massively growing trend. I know this from my own business because January 2022, I did 3 times the number of consultations than I did in January of 2021.
Wow.
Literally 3 times the number of consultations, one-on-one consultations. I know this from my own practice, that it is a rapidly growing trend of location independent entrepreneurs. Even people who have like regular jobs are going to their companies and saying, "Hey, how about hiring me as a freelancer and 1099ing me?
Yeah.
And I'll start my own business." Like I have one example of this is a client of mine. He was an engineer, industrial engineer, which is a pretty old world, stodgy, traditional style job, right?
Mhm.
Industrial engineer. I mean, he literally designed like boring stuff like bridges, right? And he went to his employer a few years ago, and I don't know if you've read the 4-Hour Work Week.
I'm actually reading that right now.
Okay. So if you read the 4-Hour Work Week, Tim Ferriss talks about how, to kind of gain some freedom in your life, you can go to your employer and negotiate to a remote work environment and maybe even expand that to be a freelancer, right? So he did all the steps, just like in 4-Hour Work Week. Initially, he got to work from home 1 day a week, then 2 days a week. Then he got a remote work arrangement where he could work from home as an employee, remote work from home as an employee, and he came into the office like once a month for meetings.
Yeah.
And over the course of about a year, he kind of transitioned that employer. He said he went to them after a few months and of it working great as a remote worker, everything was fine. And he went to them after, I think it's like 6 or 12 months, several months, whatever it was. Mm-hmm. And he went to them and said, "Listen, why don't you just fire me? I'll save you on all the benefits, all the payroll tax expense and stuff. And you hire me as a contractor, and you just give me a 1099 at the end of the year." Mm-hmm. Right? So he got them to agree. It took a while to get them to agree, but they finally agreed to that. He created a company, and he invoiced him for the work done. Well, the cool thing about this is, first of all, that freed him up completely remotely. He didn't ever have to go into offices for meetings, completely freed him up. So now he started spending his winters, he split between Arizona and Wyoming. So he stayed in Arizona for part of the winter, and then he went to Wyoming for part of the winter to go snow skiing, Jackson Hole. And then the rest of the year he spent in Greece. He had family in Greece, and they had a house near the coast, and he spent the rest of the year in Greece. So by doing that, first of all, he got to take advantage of all of the write-offs as a self-employed person.
Yeah.
So he actually got to write off a ton of stuff he couldn't write off as an employee, because as an employee, you have a limitation on how much you can write off for business expenses, up to a certain percentage of your AGI, adjusted gross income. So he got to write off a straight line expense, all this stuff that he did. So he reduced his taxable income dramatically. And then just from a tax standpoint, then he also was able to take advantage of what's called the FEIE, the foreign earned income exclusion.
Sure.
Because he was living the majority of the year actually in Greece. He was roughly 2 or 3 months in the US in the wintertime, and the rest of the year he was, let's say 3 months in the US, 9 months he was in Greece. And I'll get into that in just a second on the foreign earned income exclusion, because this is a massive tax loophole for people who want to get out and explore and take advantage of, kind of a more adventurous lifestyle and that sort of thing.
Okay.
But the other thing he did, which I think is ridiculously cool, is what he ended up doing is hiring engineers in India to actually outsource all of his projects.
Wow.
And so now he's not even doing the project. He works as a project coordinator or project manager, and he hired 2 or 3 engineers in India to outsource the projects. And he actually went out at this point and went and got 3 or 4 other engineering firms as clients. And so he basically 10x'd his income with less work because he outsourced all of his work to engineers. And I don't know what the billing rate is for an engineer, but let's say, I don't know, let's say it's $200 an hour. I have no clue. That may be a ridiculously low number. I have no clue. But let's say it's $200 an hour and he's paying engineers in India, let's say $50 an hour, and he's netting the difference of $150 an hour himself. And he just goes out and finds more clients, and he basically 10x'd his income with less work by doing this. And then he cut his tax bill. I don't know what it is now. It's been a couple of years since I talked to him, but for several years, he basically was paying 0 tax.
Okay.
But I think he went over a certain threshold now that he has a higher tax rate because he went over the FEIE limit.
Oh, sure.
So on the FEIE, I'll hit on that topic just real quick for anyone interested. And I will tell you, I know all the excuses on why not to do it. I have kids in local school. I can't do it because I have kids. I have my family is local. I could never move abroad because my family lives here. All these other things. Everyone, and I say they're excuses. It's not really necessarily excuses. To some people, it's a lifestyle choice. One of my best friends lives in North Carolina. For him, his idea of travel is, putting the dogs in the car and driving 3 hours to the beach. He hadn't been on a plane in years. Like, probably 5 or 10 years he hadn't been on a plane. So some people, it just doesn't make sense. But for the people who say, man, I would really love to do what you do, Bobby, and go live, like I live between 3 countries and then I travel a lot, like even amongst the year, but when I'm in 3 different countries. I have 3 homes in 3 countries and I travel between all of them. And some people say, man, I would love to do what you do, but I just can't afford it, is always the first one. Well, first of all, affording it is kind of a cop-out excuse, because part of the way I afford it is because I have dramatically minimized my tax burden in the US so that the amount of money I save on tax pays for all the other lifestyle.
Yep.
Okay. So just by doing that, I save enough money to afford the lifestyle. So saying I can't do it because I can't afford it, that's a whole, okay, if I make $28,000 a year, yeah, it'd be a bit tough.
Right.
to do certain things. But to be honest, if I made $28,000 a year, I could easily go live in Mexico at 1/4 the cost of living and pay zero tax.
Right.
Piece of cake. So you really could do it once you saved up, if you could work remotely, if you had the capacity to earn your income remotely. Like I've got clients that are not high earners, that are, freelance guys that make 40, 50, 60 grand a year. They're not high earners. But they pay zero tax and they live in lower cost of living places. And,
right.
One little thing that people never really consider, especially Americans, is because we're delusioned into the idea that we have the best healthcare in the world. In my experience, I avoid US healthcare at all costs. Like if I need to go to the doctor, I usually wait till I'm out of the US to go to the doctor, because most of the doctors I go to in the US are very antiquated.
Yeah.
Like if I go to an eye doctor in Lithuania and then I go to an eye doctor in the US, it's literally like in the US, I just went back in time 20 years. They're so much more advanced. Like the eye doctor in Lithuania is so much more advanced. And it's weird. And it's like 1/4 or 1/5 the price.
Yeah.
Like, I had a friend of mine recently who told me he got LASIK and he was in Atlanta, Georgia. And I think he paid like a couple of grand per eye.
Sure.
You can get LASIK in Lithuania for about $400 an eye.
Jeez.
and they're actually like a higher level of technology than what you get in the US for most of those doctors. So better quality at 1/5 the price. But like those things factor into cost of living, right? Because healthcare is one of our biggest expenses. Housing, transportation, healthcare, food. These are like some of our big chunks of money that we, spend in our regular budgets. And taxes, right? Taxes is also one of those. So, from a tax standpoint, circling back to the foreign earned income exclusion, you can earn easily 100 this year. I think it's 110,000 this year. You get 110,000 tax-free earnings in the States if you live abroad. Now, there are some, caveats to that and how you qualify. To qualify for the FEIE or the foreign earned income exclusion, you have to qualify one of two ways. One is what's called the physical presence test. So you have to be physically out of the US 330 days a year.
Okay.
So this would be the people that say, oh, I've got family in the US. I couldn't be back. I couldn't be gone, 11 out of 12 months, basically. Sure. But see, there's also the second way to qualify is what's called the bona fide residency test.
Okay.
And so if you qualify under the bona fide residency test, meaning you actually become a bona fide resident in that other country, using, let's say Costa Rica as an example. Okay. You go apply for residency, you immigrate as a legal resident in Costa Rica. Then you become a bona fide resident of Costa Rica. Now, once you are considered a bona fide resident, you can qualify for the foreign earned income exclusion in the US under that bona fide residency program. And then you can actually have a lot more flexibility on how much time you're in the US. On average, it works out to be roughly 4 months a year.
Oh, okay.
Okay.
More palatable there.
Yeah. And so there's other things to consider, right? So like Costa Rica is a good example here because Costa Rica doesn't tax you on income you earn outside of Costa Rica.
Okay.
So if you properly structure your business and your investment holdings, then you don't pay any tax in Costa Rica because Costa Rica is what's called a residency-based territorial tax system. So you don't pay tax in there, and then you get 110,000 tax-free in the U.S. Plus, there's also a housing allowance you get per family that varies by country, but using Costa Rica as an example, it's roughly 40,000.
Okay.
So you can actually earn about 150,000 tax-free.
Nice.
If you were married, you pay your spouse 110, you pay yourself 110. You can actually get, plus the housing allowance for the family. So that's
Sure.
what, 220, about 260 roughly,
Okay.
tax-free.
Okay.
Theoretically, if your kids were old enough, you'd be hard pressed to get away with it if you had like a 3-year-old and a 5-year-old.
Sure.
But if you had a 14-year-old and a 16-year-old, pay them 110 each also.
Okay. Interesting.
Depending on your income level, obviously. Now, if you pay a 16-year-old 110,000 a year, he has to file a tax return, but he also gets the foreign earned income exclusion.
Okay. Wow.
Right. There's a lot of different things you can do there. And, and people say, oh, I couldn't do that. My kids are in school. Well, the one thing I've learned about traveling, I've been to about 80 countries. I've lived in more than a dozen. I've legally immigrated to 6 different countries.
Okay.
And one thing I know about my travels is every country has schools. Yeah, I know that's a little facetious, but yeah, every country has schools, and some of them are actually really good.
Yeah.
In what I've seen, every medium to large city in any bigger country has international schools.
Mm-hmm.
And they're usually not terribly expensive. Now, some countries, they are crazy expensive.
Sure.
You put your kid in an international school in Zurich, it's going to be crazy expensive.
Make Harvard look like a deal, probably.
Yeah. Or Oslo, Norway, or Singapore, or Hong Kong, or places like that. Yeah, you're going to pay through the nose if you put your kids in private international schools there. But then there's other options. There's online schools. Like I had my kids in a private online school for a few years, and it was pretty cheap, like $2,000 a year. And it was fully accredited private online school. And kids are used to online school now anyway, with all the COVID stuff. They do all their assignments online. They do, depending on where you are in the world, they're either fully online now or partially online now. I don't know. It depends on location, but pretty much every kid in the world, almost every kid in the world for the past year has had some version of online schooling.
Right.
So,
which then right there might kind of knock out the excuse of, well, they have good schools. It's like, well, if it's now online, or the potential or capacity to be online, like you said, you can be in Zurich, you can be in Singapore, you can be anywhere and take it.
Yeah.
As you got a connection.
My youngest was doing his full school program online in about 3 hours a day. He finished all of the assignments in, like 3 hours a day when he was doing it. And, that left him a lot of free time to do other stuff. He had basketball, he was doing judo and all this other stuff. He had a lot of free time to do extra stuff and self-learning, also self-learning. Or you could do what a lot of expats do and just do homeschooling or online schooling, which is also a great option.
Mm-hmm. No, I agree with that. So one quick
but
question.
That's just I know I went a little bit off on a tangent there.
Oh, no worries.
But to circle back, that basically from a tax standpoint, if you move outside of your home country, the point I was trying to make is whichever country you're from, it doesn't matter if you're an American, you're a Canadian, you're a Mexican, you're German, whatever. No matter which country you're from, the simple fact of moving outside of your home country does a lot of things. From a tax standpoint, this is crazy to imagine, but it is what it is. You are always treated better as a tourist or an immigrant than a citizen from this perspective. Because there's a lot of things, like, for example, in Europe, you don't become a tax resident in most of your European countries unless you're there more than 183 days.
Okay.
So you can actually go live in Europe for 5 months and never pay tax there. And then, go live in Mexico for 5 months, don't pay tax there. You take advantage of the foreign earned income exclusion in the US, and you get that 150,000 roughly tax-free from the US perspective, and then go spend a month in the summer and a month at Christmas visiting family.
Wow.
Like, I mean, just a hypothetical example, but you treat
Sure.
it better as an immigrant or a tourist than you are as a citizen in most countries, or as a resident in most countries. And so it's actually not that difficult to kind of arbitrage countries for things where, like, from a tax perspective, you can be treated better here than here. Like, I part of the reason I live in 3 different countries is I take advantage of different things in different parts of the year. Like, I like to be in Europe in the summertime because the weather is amazing. It's beautiful. The healthcare is world class. Like, I'm planning to get some eye surgery this summer while I'm back in Europe.
Okay.
Because it's ridiculously cheap. It's literally, the surgery I'm looking at is about 1/4 the price of what it is in the US.
Wow.
But it's a higher level of service, and it's not an immediate thing I need done. So I can wait till July or August to get it done. No big deal.
Okay.
Dental work in Mexico is generally very, very high level. You know, like my wife just had a bunch of dental work and had some stuff done, and we intentionally will come to Mexico if we need dental work done.
Yeah.
Because, you know, we live here in the wintertime anyway. So you can arbitrage things for where you're treated best for certain things. Like, it just depends on where you want to be. But you can also just go live somewhere as an expat and take advantage of certain things there, you know, too, instead of being more you know, nomadic like we are. We call ourselves slow-mads, right? Like, you know, the digital nomad craze is you got all these 20-something-year-old kids that go live in a place for a few weeks at a time. We don't really do that. We just live, we have 3 home bases is what we do. So we call ourselves slow-mads.
There you go. Hey, whatever works. So,
but I have countless tax examples if you want to discuss more tax stuff on.
no, I actually like those examples. And like I said, I think we can go down the rabbit hole for hours on end, and, you know, maybe even do a separate podcast solely on taxation. Maybe shifting gears here, we can kind of get into the structuring, you know, with, you know, asset protection, LLCs, and trusts. And we will get into that here right after a short message from our sponsor.
This show is brought to you today by Timothy Hero with Hero Mortgages. Did you know traditional lenders cap you at no more than 10 rental loans in your name? Many have complicated underwriting processes, and if you are self-employed, even more documentation and income verification is needed. Why not work with a loan broker that can get you the best terms with an unlimited amount of loans for your investment properties? 30-year fixed rates starting at 5.8%. These loans do not report on your credit report, can be done right in an LLC, and can be used for 1 to 30 unit properties or portfolios, all with faster closing times and less documentation than a traditional lender will require. Check out episode number 17 for more info, or go to timothyhero.com to get a quote today.
All right, moving on here, Bobby, kind of going into the asset protection world, if you will. And I know you gave a very unfortunate example of one of your clients that literally lost everything with, you know, not having the proper structures in place. Very high.
Well, but let me clarify. She wasn't actually a client because she chose not to hire me.
Oh, okay. Potential client, too late. Maybe we should specify that.
We did an initial consultation with her, and then she said, you know, I don't want to spend that much money to put this structure in place. And then, you know, but her 2 business partners did put something in place. So that's why I call them like the 3 little pigs.
Yeah. 3 little pigs. Wow. Now maybe high level, and I, you know, I've briefly touched base on this on a couple of other podcasts. Very high level. A lot of people are familiar with asset protection structures and the concept of a trust, and then also in a concept of an LLC, or what the foreign equivalent would be, you know, if you're outside the United States. Could you briefly, you know, for my clients and, you know, non-legalese, so to speak, kind of a basic definition of both of those and how they differ?
Sure. So from an asset protection standpoint, you've got to look at a few different things on on how you protect your wealth.
Okay.
Right. So the first thing I like to look at, kind of if you look at it like this, imagine a castle, right? And you've got a castle surrounded by big walls, right? And these are kind of your protections to the castle. And then what do we normally have outside of the wall of a castle? We have a moat, right?
Okay.
And, sometimes those moats are filled with crocodiles or whatever, piranhas, whatever, right? So you got a moat, you got a wall, and then your castle on the inside. I look at asset protection a little bit like a castle. You got to build your moat around the structure, and then you got to put up your legal walls of protection to protect the asset itself. So the moat is a little bit, I consider the moat to be privacy.
Okay.
So what we don't know, like for example, if let's say, just give you an example. We'll use you, John. Let's say you have a Super Bowl party, and your buddy, let's call him Mike. Let's say your buddy Mike drinks a bit too much beer at your house at the Super Bowl party. He drives home, he's a bit drunk, gets in a car wreck and kills somebody, right? And so what's going to happen is the injured party, the family of the injured party, they're going to sue Mike, of course, right?
Yeah.
Obviously, they'll go after him. He'll have some insurance with his car, but we're talking about a death in the family. Your $100,000 limit on your liability and your auto policy, or $500,000 or whatever you got, that's not going to satisfy an injured party for a death in the family, right? I mean, and you've got to think like, again, these are unforeseen circumstances, but imagine the guy that got killed had a newborn baby, and he was the sole breadwinner in that family. And now you've got to not only have like an injured party there, but now you've got a newborn baby that you literally will have to pay for that child's life until age 18.
Wow.
I mean, that's a lot of money we're talking about in a lawsuit. I mean, millions and millions, right? So the injured party, they're going to sue Mike. And then what are they going to do? They're going to find out Mike left your house drunk. So they're going to sue you, John. They're going to come after you. Now, what typically happens in that type of lawsuit? You've got the injured party's lawyer. The injured party will go hire up the lawyer, and they'll say, I want to go after this John guy because, we want to sue him for, I don't know, let's say $5 million.
Okay.
Okay. And the lawyer will say, all right, let me do a little bit of research. We'll probably be able to take this case on a contingency.
Yeah.
If you don't know what a contingency is, look at it like a commission.
Yeah.
If they collect $5 million from you, then they get paid out of the $5 million.
Yeah.
20, 30, 40%, or whatever the contingency rate is, right? And so the lawyer will tell the client, the injured party, that, okay, we'll probably take this on a contingency. Let me do a little research on this John guy and see what we can do and get back to you. Mm-hmm. So what they do is they're going to go do an asset search on you to see if you are, a viable target to collect anything from, right? Yeah. They're going to do a credit search to see, they can kind of extract information from your credit report. And a lot of people think, oh no, you can't see anybody's credit report. Well, that's nonsense. I can pull your credit report probably before we get off of this call. Okay. Like, it's not that hard to do.
Right.
You just got to know what you're doing. But I can pull some information out of there. For example, I can see, oh, looks like this John guy here has a mortgage for, I don't know, $500,000. Well, let me go pull up to see what property he owns. Okay, I know he lives in XYZ town. I'm going to go pull up the property records in that town. Oh, looks like this house has a tax value of $1.5 million. He's got a $500,000 mortgage. I know he has a minimum of $1 million net worth in this property, right? $1 million in net equity.
Yeah.
Okay, well, I know he can pay this amount of money in a monthly mortgage payment. Let's say $5,000 a month in a monthly mortgage payment. Well, I know at a minimum, the way the banks look at mortgages, I know they need at least 3 times that income from an income perspective to qualify you to pay that mortgage. Mm-hmm. So, okay, well, I know he makes at least $15,000 after tax, right? If you paid a $5,000 mortgage. So on and so forth, right? I can extract all this information from your credit report. I can do a record search. I can see what kind of car you drive. If you drive a 98 Toyota Corolla, that gives me a very different picture than if you drive a 2020 Aston Martin.
Right.
You get my point, right? So I can pull all this information up because this is all public record information.
Yeah.
Super easy to find, right? So this is kind of what I consider the moat around your castle, is get your name out of public record.
Okay.
Put that privacy moat around your life. Do not own assets in your own name at all, ever, anywhere. Don't use your home address in public record anywhere, ever. And I mean on anything, anywhere, ever, including your driver's license.
Wow.
Don't use your home address. The place where you hang your hat at night and go to sleep should never be in public record. I tell people, literally, if you have a mailbox on the curb, go out there with an axe, chop it down, and take it down, and go get a virtual mailbox or an address with a UPS store or something to receive your mail, and go file the form with the USPS to have your mail forwarded to that address. Never give your home address anywhere ever in public record.
Wow.
Okay. Never own an asset in your own name. If you have a taxable brokerage account, create an LLC and put it in the LLC's name. Okay. If you own a house with a mortgage, put it in a land trust. If you own a house free and clear, put it in an LLC. If you own a business, run it through an LLC. If you can use trust, you can use, and we can get into the description, but I wanted to give you kind of a background on asset protection.
Sure.
So the first step for asset protection planning is to not own anything. You want to look completely broke in public record. You don't want any assets in your name. I don't even own a car in the US in my name. I have an LLC that my name is nowhere attached to it that owns my car. Okay. So if you were to ever, I don't know, like back to the lawsuit example, somebody's coming after you and that lawyer's having a hard time tracking you down. Well, they say, all right, well, I'm going to go hire a private investigator to kind of find some information about this guy. And they catch me, at the supermarket driving my car, and they're like, aha, there he is. Right. And so they get my license plate number, and then they pull up the ownership records of my vehicle based on the license plate number. Still, my name's not attached to it. They have no idea who owns my car. Okay. And I know this stuff seems like it feels like if you've not been down this road, it seems like that's just extreme. That's crazy. Why would I do this? This is stupid. It's like complete waste of time and energy and effort. And you know what? If I made $28,000 a year, yeah, it probably is a bit overkill.
Yeah.
Right. Because I'm not a target for lawsuits. But the more income you have, the more assets you have, the bigger that bullseye is on your back. Right. If I got a business doing a couple of $1 million a year, I've got a few rental properties, I'm maybe got some other investments. I've got a net worth of $4, $5, $6 million. That bullseye starts looking pretty big on your back. And then your net worth goes up to 10 million or 20 million. The bullseye keeps getting bigger and bigger. And people, like I said before, people don't take the necessary steps because they're just like, I'll worry about it later.
Yeah.
But then you end up in a situation where now all of a sudden your buddy Mike left your house from a Super Bowl party and killed somebody on the way home. And now you've got a $5 or $10 million lawsuit against you because guess what? It was ridiculously easy to find your assets. And now I'm going to name you in that personal lawsuit because I know how easy it is to put liens on your house and all your investment properties and to seize your bank accounts to satisfy judgments. Okay. But the flip side to that, now let's say the lawyer for the injured party does the background search on you and they can't find anything. There's nothing in public record. It looks like you can barely afford to eat and you look like you live in a box behind the supermarket, right? You look exceptionally broke. You're not a huge target. You don't look interesting for the lawyer because he's thinking, I'm going to get paid a contingency. So what does he do if he can't find any assets in your name to make you are easily attachable in a judgment, right?
Mm-hmm.
What's he going to do? He's going to go back to his client and say, well, Mr. Injured Party, I think we can totally go after this John guy in this lawsuit, but I'm not going to be able to do this on contingency. What I'm going to need here is a $20,000 retainer to get started, right? And then the injured party says, I don't have $20,000 to pay you as a lawyer. I don't have 20 grand. I don't have the cash to do it. Right. And so a lot of times having that moat around your assets, just the privacy piece alone is enough of a deterrent to stop any future potential creditors from coming after you, because it doesn't look like you have anything worth coming after.
Right.
Right. So, I mean, that's one piece. The second piece is building the wall. This is where we talk about using structures like LLCs and trusts and insurance policies and friendly liens and stuff like that. There's a lot of tools we can use to protect your assets. And these are the walls we build around your assets. So the moat's the privacy, the wall is the structure itself.
Okay.
And so on structures, you know, we've got in the US, we've got LLCs, limited partnerships, corporations, you know, there's various type of things. We can do trust, that type of thing. LLCs for owning assets, for the most part, is your most common entity for doing that sort of thing. I'm not even sure you know this, John. I actually have a company in the US. We do company formations.
Okay.
We built a platform. We're a registered agent in all 50 states. We do LLCs and corporation formation across all countries. If you want, you can put that in the call notes. But
Okay.
we've been doing this. We've been doing asset protection for clients for almost, or I guess actually over 2 decades now. And so we actually built this platform because honestly, we were doing so many company formations for clients. We were doing it kind of the old-fashioned way. We actually built a software platform that automates everything. So
cool.
you can register your own LLC in about 5 or 10 minutes. And then it automates your annual report filings. It automates your registered agent service. It automates your renewals, paying your renewals every year. So we actually built that into, you know, full disclosure. I built that software platform because I'm lazy. And automating that stuff just kind of made sense to do it for us and our clients. It allowed us to lower our costs tremendously on company formations for clients because the software automates everything.
Well, back to the 4-hour work week, you're automating, delegating, and simplifying. So.
Yep, exactly. So, you know, I'm quite familiar with company structures. Structures is actually kind of the core of our business. We do U.S. company structures. We also, with a business partner, we also own a offshore trust and corporate service provider. So we do offshore companies, trust, private interest foundations, stuff like that in several different jurisdictions. And so on the U.S. side, LLCs are probably the most common thing because LLCs or limited liability companies are kind of a hybrid between a partnership and a corporation. You get kind of the best of both worlds.
Okay.
Corporations from an asset protection standpoint are generally not ideal because in a corporation, you own shares.
Yeah.
Okay. And if back to the drunk driver example, if you get sued and all of your wealth is in a corporation, well, the courts can actually just take your shares of your company to satisfy the judgment.
Wow.
And then then they could just liquidate the assets of the business to satisfy the judgment themselves. Whereas in an LLC, if the LLC is structured properly and in the right state, because it does matter which state you're in, but if the LLC is properly structured, that can't be done. They can't just they can't give away your membership interest to satisfy judgment in the LLC. They can't bypass the LLC. The court can't bypass the LLC to take assets in the LLC to satisfy judgment. So you have more asset protection from an LLC than you do a corporation in that standpoint. Limited partnerships also work really well for this, but to be honest, I think LLCs are a better option because they're simpler to set up and simpler to maintain than a limited partnership. you can, plenty of people still do limited partnerships, but the problem with a limited partnership is you have a general partner and a limited, one or more limited partners. And the general partner actually has 100% of the liability associated with that partnership. So if that limited partnership had a judgment against it for $1 million, whoever is the general partner is the one that takes full responsibility of that $1 million liability. Okay. And so in order to protect yourself against that, the best way to go about doing that is you actually create an LLC as the general partner, and then the general partner only owns 1% of the partnership. And then you, like in your case, John, you could be 99% limited partner.
Okay.
But it gets more, but that's like overly complicated, and you could actually just do an LLC instead. It's kind of redundant to have the, limited partnership in place, which ends up putting all the liability on the LLC when you could do that anyway with just an LLC, and then it's simpler to maintain. And you only have one structure to maintain instead of two, because in a limited partnership, you have to have the LLC plus the partnership in place, right? So I think it's a little bit redundant, but some people still do it, and they read some blog somewhere about a family limited partnership, that how great it is, and all that thing. So like a couple of things I'll note here. There's no such thing as a family limited partnership.
Okay.
That's a marketing term. It's just a limited partnership that some blogger like 30 years ago called it a family limited partnership, and so it's stuck.
Gotcha.
But there's no entity called a family limited partnership. But it's been around for so long now, people even have just called it an FLP.
Okay.
But it doesn't. And also the other thing that's a little bit of a misnomer that people don't really understand is with corporations, there's no such entity as an S corp. Okay. There's only a corporation. An S corp is a tax election.
Yeah.
Whereas a C corp is the default tax selection of a corporation. An S corp is a tax selection. Okay. You can actually do an S corp tax selection with an LLC if you want. Okay. If you want that tax selection. So you can actually get the asset protection benefits of an LLC, but you can still get the S corp tax benefits just by electing to have that. You file the IRS form. I think it's the 2554. I think. I don't know. I get the forms mixed up. But you just file that form to get the S corp tax selection for an LLC, and you get the best of both worlds there. If that makes sense in your situation. So that's just a couple of things to clarify some points. Okay. As far as offshore structures, you do have LLCs in those jurisdictions. You also have IBCs, international business companies. Okay. There's other things like private interest foundations, which the U.S. does not. In the U.S., under the Internal Revenue Code, there is no such thing as a private interest foundation. So you have to consider what we kind of jokingly call the duck rule. You know what the duck rule is?
No, maybe actually clarify that.
If it looks like a duck, it walks like a duck, and it quacks like a duck, it's a duck.
Gotcha.
So under the duck rule, a private interest foundation under the Internal Revenue Code is treated like a trust.
Okay.
An irrevocable trust. So there's been a lot of misinformation on the internet about, the U.S. doesn't recognize private interest foundations, so we can use offshore private interest foundations. We don't have to report anything back to the IRS because the IRS doesn't recognize them. Well, you might get away with that for a little while, but if you ever get caught, they're going to treat that as a trust. And if you never filed the 3520, which is the form you file with the IRS if you're the grantor of a trust. Okay. If you never filed that 3520, then the IRS doesn't consider that. They just don't consider it as an entity in existence. They don't consider that trust to even exist. And so they would disallow anything and treat it as if it was your assets in that private interest foundation. So because of the duck rule, if you have an offshore private interest foundation, you need to treat it like a trust and file, if you're an American, and you file a 3520 to have it recognized by the Treasury Department. But, there's still good reasons to do a private interest foundation or an offshore trust, from an asset protection standpoint. From a tax standpoint, for the most part, there are some complex things you can do as an American, but for the most part, most anything you do offshore is going to be passed through back to you in the US.
Okay.
Now, I know you wanted to flip to the asset protection topic, but since we're on the offshore thing,
Sure.
I will mention one possibility. If you have clients that have if their business would kind of fit this niche, there is a way that you can get your corporate tax rate down to 10.5% using offshore structures. Right now, the corporate tax rate in the US is 21%.
Right.
However, if you have profits from an offshore entity, under the new tax rules since 2017, if that offshore company has a U.S. parent, which is a C Corp, a corporation taxed as a C Corp. So if that C Corp has an offshore entity earning profits, the profits from that offshore entity would pass through to the C Corp, but they get a 50% tax rate deduction. So instead of 21%, you're taxed at 10.5% on profits from the offshore entity. So I've got a lot of clients who have, like, let's say, virtual businesses or digital businesses. And what we do is we run Americans living in the US. What we do is we run all their profits through an offshore company, but we create a corporation in the US that owns that offshore company. And so then they get a 50% corporate tax rate deduction down to 10.5%.
Nice.
So that is one kind of cool loophole that you can use to get a tax deduction on corporate. That's only on your corporate tax rate, right?
Okay.
You only get that on your corporate tax rate. So right now it's 21, you get a 50% deduction down to 10.5. Now, I would say if you were earning, let's say, if your business was earning, let's say around 100 up to 150,000 approximately.
Okay. All right.
That would be a pretty cool structure to use. I mean, it'll cost you a few grand to set it up, but it would be a pretty cool structure to use. Let's say your business is doing $500,000 in revenue and you've got a net profit of about 150 grand, roughly 30%, right? So that 30% profit would flow through to your USC Corp. You'd be taxed at 10.5%. Let's just say 10% to make my math easy.
Sure.
So you'd pay, like on 150, you pay about $15,000 in corporate tax. And then the cool thing is pay yourself a salary of under $43,000.
Okay.
So pay let's say $40,000 salary. And then you would give yourself a dividend for the rest of the profits, because if your salary is under 43, your dividend tax rate is 0.
Oh, okay.
Okay. So on a qualified dividend, qualified meaning it comes from a U.S. corporation. On a qualified dividend, if your taxable income is under 40, I think it's like 43,000 this year. But if your taxable income is under 43,000, then you get a qualified dividend tax rate of 0%. If you go over that amount, your qualified dividend tax rate is 15%.
Sure.
But the reason I say if your profit's under about 150, you can kind of get away with that. But if your profits were, let's say, 2 million,
sure.
I think the IRS is going to look a little funny at you if you make $2 million a year in your business and you pay yourself a salary of 40,000.
Right.
But you could probably get away with that up to, I'm approximating about 150,000. You could reasonably say, a third of my profit, roughly a third of my profit or a fourth of my profit would be salary and the rest in dividends. I think is a reasonable way to go about it.
Sure.
So you can kind of make that work in that situation. And then you would only pay your personal income tax rate on a low salary of 40,000. And then you take a dividend of, let's say, $100,000 a year at zero.
Okay. So, and even if it went above that, I mean, I've always looked at dividends where, if I get a salary up to, well, I think it's like 140,000. Well, that gets hit with the self-employment tax with FICA 15.2%. Right out the
15.3,
gate. Yep. Right out the gate, no exemptions, no deductions. And then you have, maybe your top tier federal tax rate in the 30%, where, okay, if I can just get paid a dividend, okay, I don't get 0%, it's 15. Well, 15 might be 1/3 of what I would pay as a salary, paying the self-employment tax and up to the highest marginal federal tax.
Right. Yeah, and you can get away with it like that, but still you got to consider the amount of your salary versus the profit in your business.
Sure.
Like, if you're making $2 million a year, a salary of 100,000 is still pretty low.
Yep.
Right. Like I would say 2 million a year, your salary should be at least like 250.
Sure.
Minimum. But you only pay that 15.3% on your first 130.
Sure.
The cutoff is roughly about 130, or I don't know. I don't keep up with it exactly because it goes up a little bit every year. But last year it was about 130 was the cutoff. So you pay 15.3% on the 130 if your salary was 250, and then you pay your normal income tax rates up to 250.
Right.
Yeah. So that's one thing. Like if your income is at that lower level, pay yourself that salary of 40, then you dividend yourself out, then you pay zero on your dividend. Wow. But if you were, like you said, if you made 2 million a year, pay yourself a salary at 250. And then if you wanted a bigger dividend, you didn't want to retain earnings. But remember, you can retain earnings in the corporation now, tax deferred indefinitely.
Mm-hmm.
If your dividend tax rate is zero, why would you leave it in your company?
Right.
That's just silly, right?
Mm-hmm.
Dividend all of it out. If your tax rate is zero, because then you get it, where you can do whatever you want with it. Because what happens next year, all of a sudden your business grows and you have to pay yourself a salary of 150,000. And now you're like, oh, I should have dividended myself last year, but now you can't. And now you're going to receive it and you're going to pay that 15% tax rate.
Gotcha.
On the dividend.
All right.
So there's all kinds of little tricks you can do. I mean, that's one. Like if you run business through an offshore company, there are some options with using nominees. You can defer offshore. I would say that's generally for more high-level people, higher income people that are more accustomed to more complex structures, because it gets a little tricky on some of that stuff. But I've got some pretty high net worth guys doing stuff like that are saving massive amounts of money. I had one client, I'll give you one story. I had one client, e-commerce seller. We set up, I've actually known, he's a good friend of mine. I've known him for years and years. I've helped him set up his structure for his businesses. I think his last 3 or 4 companies.
Okay.
He's had exits in all of them. He sold all of them. I've even actually, the last business he sold, the buyer is now my client because, I took on the structure and managing the structure for the buyer. So now, like the guy who bought his previous business is my client. So like, I've been with this guy for years, and it's funny. So we created a structure for him, and he's American guy. He was originally from California. So he was paying that stupid state income tax rate. And he decided years ago he wanted to go move to Southeast Asia, and he was going to bounce around between like Thailand and Bali and Vietnam and stuff like that. Okay. So what we did before he left California, we helped him, at least on paper, move to, I think we did Nevada. Yeah. Because California is a little bit tricky, even though at the federal level, you can qualify for that foreign earned income exclusion when you move abroad. California doesn't care about that. They still want to tax you at the state level. They don't care if you live abroad, if they were your last state of residence.
Okay.
So what we did is we moved him to Nevada, which is a zero tax state. So right off the bat, he saved 12% income tax rate.
I think it's like 13.2 or 13.3 now is the high one.
Yeah, I think it went up a couple of years ago, but this is before that.
Okay.
It was about 12%. But right off the bat, we saved him 12% off the top. And at that time, he was making like maybe 200,000 a year or something like that. So it was a pretty decent chunk of change he saved off the top. And then he moved to Thailand. So then he disconnected himself from California before he left the country. And so he didn't have any more issues with California.
Okay.
So some of this stuff you have to take in steps, right? And so then he left the States. Then he qualified for the foreign earned income exclusion. He had about roughly 150,000 tax-free he was earning.
Okay.
But then his business grew and he was earning quite a bit more. So we restructured his business so that he was able to defer all of his profits in his business. He was able to defer it offshore for a few years. So actually we got his income at this point was up over $500,000. He was paying zero in tax.
Okay.
And then last year, he came to me and said he wanted to start investing in real estate in the US. So the problem is he didn't have, because he was deferring all of it in this offshore company, he wasn't showing much personal income in the US, okay? He was only showing his 150,000, which was not taxed because of the foreign earned income exclusion.
Sure.
But he wanted to start buying some real estate and his income wasn't high enough to qualify for some of the loans.
Sure.
So we did a restructuring of his business again, and we did what I mentioned previously. We added the C Corp as the parent to his offshore company.
Okay.
So we allowed all the profit now to flow to the C Corp so he could show, so we cut his corporate tax rate in half for what it would have been without the corporation. But he ended up paying much more in tax because he was actually paying nothing.
Okay.
But now he's showing 7 figures in income. And so now he can go out and qualify for these really low interest loans.
Yeah.
And he can take advantage of leverage in his investments and stuff. So sometimes you do one thing now and your situation changes. We have to adjust and change something later also. But like in his case, he's still paying at the corporate level about 10% tax, whereas, you know, I mean, that alone saved him a couple $100,000 right off the top.
Wow.
By doing that. And now he also gets the higher like official income so he can apply for loans. And I know he went out and just, he ended up getting a business loan for a couple $1 million at like stupid low interest rates. And then he ended up buying a couple of properties that he got qualified for because his income now is high enough.
Nice.
You know, at low mortgages. So, you know, there's a lot of things you can do, but people's situation also changes too. So you have to be flexible and adjust stuff sometimes.
Okay. Wow. Yeah, just definitely a lot of routes to go. I've actually picked up a few nuggets myself and maybe even structure my businesses and finances, shall we say, a little bit different to, like you said, still qualify for loans, but then pay less in taxes and get that all straightened out. Bobby, as we wrap up here, if anyone listening to this, maybe, you know, a high earner, maybe a sales consultant, maybe a business owner, you know, maybe you're hearing some of this about tax restructuring, LLCs, trust, etc. If they were interested in learning more and maybe reaching out to consult with you and your team, what's the best way to reach out to you?
We have our main website, Global Wealth Protection, globalwealthprotection.com.
Okay.
We got a lot of information on there. We've been writing a blog since 2008.
Oh, wow.
I've got 14 years of blog history in there. You know, if you really want to amuse yourself, go back 14 years and read our blog posts versus today. I've done that fairly recently, and I thought, oh my God, I need to delete that stuff. It's so bad. You know, you get better as time goes on, right? So, yeah, we've been writing a blog since 2008. So you can go read a bunch of blog articles. We publish at least 1 or 2 pieces a week. Our membership program is on there. So for members, we have an annual membership program where members get our gated content. So our gated content is very specific, hands-on, actionable information about tax planning, offshore trust, offshore companies, private interest foundations, company structure ideas, asset protection, privacy, stuff like that. And then in addition to our gated content, members also get access to like my personal Rolodex of contacts, like accountants, CPAs, bankers, stuff like that. We also have some pretty detailed reports in there, like our offshore banking report, our privacy report, stuff like that. Like our privacy report's pretty cool. It actually teaches you kind of how to go off the grid without having to go live in a cabin in the middle of the woods in Idaho.
Gotcha.
Basically, it's going off the grid from just a public record standpoint. So I have to pat myself on the back for that one. It's a pretty good report. And then the big thing with our membership program is members can get basically 1 hour consultations with me as needed. So the membership it's the first year fee is $1,297, $1,300 basically. Which my coach, my business coach, I have a business coach. I just raised my price recently on that, and my business coach is still pissed at me because he thinks it should be at least 5 times that.
Yeah.
He's been yelling at me for years to raise the price. I finally did it. And now he's actually pissed at me that I didn't raise it like 5 times what I raised it to,
Sure.
But it's $1,300. I mean, I charge for hourly consulting. I charge $445 an hour, and members get an hour consultation as needed. So like if you want to schedule a consultation a month for the next 6 months, you can do that.
Okay.
So it's a screaming deal. And then our other website is businessanywhere.io.
Okay.
And that's what I was talking about before, that we created this platform for U.S. company formation in all 50 states, registered agent service. We also have a virtual mailbox service, which is really good for like travelers, digital nomad types, RVers, people that are just location independent, people that are really interested in privacy and don't want to use their home address for public record. So we have a virtual mailbox service, and then we also have a remote online notary service, because we have a ton of clients that are needing to do remote online notary. We also have a lot of non-US clients. Actually, more than half our clients are non-US.
Okay.
We have a lot of Canadians, a lot of British clients, a lot from various European countries, Australians, Russians, and we actually are one of the few online notaries that can notarize documents for non-US persons.
Oh, very good. As this recording, my podcast has been downloaded in about 21 additional countries outside of the U.S., so it might be very handy for any of my listeners out there that are in the Philippines or Canada or Mexico. So,
well, it's funny. Like I looked at my report recently on Business Anywhere. We do a lot of company formations for non-U.S. persons because U.S. entities are actually a really good option for non-U.S. persons for tax purposes. The U.S. is by far the biggest tax haven in the world, just not for Americans.
Right.
Like, for example, if you're a Russian and you want to invest in the stock market in the U.S., you can do it through a U.S. LLC, completely tax-free.
Wow.
100% tax-free. Whereas as an American, you would still have to pay, capital gains or, dividend tax or interest income and stuff like that. But as a non-U.S. person, you can trade the U.S. markets through a U.S. entity 100% tax-free. So we get a ton of non-U.S. persons registering LLCs just for the purpose of investing in the U.S.
Interesting. All right. Well, a lot of good nuggets there and a lot of good information. And thanks again, Bobby, for coming onto the show and sharing your expertise and your businesses with all my listeners.
Thanks for having me, John. Have a good day.
You too. Thanks.
Thank you for listening. Be sure to share, rate, review, and subscribe on your favorite podcast platform. For more updates, check out www.wealthandfreedomnexus.com. Remember, nothing on this show should be considered tax, legal, investment, or professional advice. This show is produced solely for educational and informational purposes. Please consult an appropriate and licensed tax, legal, real estate, or business professional for specific advice for your situation. For distribution or publication rights or media interviews, please contact the host.